Hopefully what I'm intending to provide to you today is very much an overview from a market perspective. I look after the residential capital markets team within JLL in an advisory capacity. A lot of my work covers the whole residential investment spectrum. Historically, I tried to do this about 20 years ago and then fell into the wonderful world of student accommodation as institutions tried to get exposure into the residential market. And it's fascinating just to see how the market is maturing and the catalyst that I see the student sector was into the emergence of the build-to-rent sector. So just with that background, in terms of context, I think these are well-proven statistics that frankly we're just not building enough and continuing to fall some way short of the demand that exists in the market. That, at a very base level, is a really interesting place to start an investment strategy. Not enough supply, loads of demand. So it's amazing to me just how long it's taken the institutional sector to actually recognise the simplicity behind this investment opportunity. So, what does that shortage of supply mean? Basically, greater levels of unaffordability in the sector. So, politically, really driving enthusiasm to try and find a solution, not surprisingly. Only a quarter of 30-year-olds are predicted to own their home by 2020. And I'm a big advocate of renting now being a tenure of choice rather than necessity. So I think there is a lot of noise still in the market around the affordability gap, but actually the new Y generation are much more discerning, and I think the market around renting will become less about an Englishman's home as his castle, but a greater acceptance in the wider piece. And of course, people move around a lot more now. So do they want to be in a single location for the rest of their life? Most probably not. Renting obviously offers you that greater flexibility, whether it's across the UK or on a much more global scale. There are challenges, though, in terms of the delivery, as we've heard, not just from a construction perspective, but also in terms of the planning environment as well. I think 40% of local planning authorities still don't really have a full grasp, and I think there's some pretty horrific statistics out there in terms of just exactly what is required and the certainty around that delivery process in a planning context. Pace of development too slow. Mark's obviously highlighted that. I think the house building fraternity get a bad press in terms of land banking. Ultimately, they will build more if the market is there, as touched upon in terms of the peaks and troughs in terms of the construction demand cycle. That's driven by market dynamics ultimately. So it's a critical thing to bear in mind. And frankly, we've got too much reliance on a much smaller pot of developers post-financial crisis, restrictions in funding available to regional smaller house builders in particular has really put pressure on the big boys, and in that context, not necessarily that big when you get off the top five or so. So really looking to try and evolve a much deeper delivery mechanism into the housing sector. So the housing white paper, obviously a huge amount of noise and anticipation in terms of what that was going to bring to the sector and more than anything within the build-to-rent community. I think there are obviously a lot of positives there. As a business, I think there's a real focus, a real foundation to establish some real key drivers into increasing supply. Not perhaps necessarily the glitzy headlines that that we may be more used to seeing, but I think some real basics from which to grow. So standardising methodology and actually having determinant area plans, simplifying the plan making process itself. What actually can we get hold of in the development community to bring forward and its supply? Again, going back to the basics, if you've got new supply coming in or limited supply, that has a real bearing in the investment community in terms of what's a good investment or not. Clearly streamlining the planning process, buying land and holding it without a planning consent and therefore being able to deliver is not a good place to be. It's not a useful utilisation of your capital. Investment community wants a return. So we need to fast track that element of the process as well. That's been recognised within the white paper. Obviously coordinating infrastructure improvements, as Mark alluded to, obviously a key driver in terms of housing demand and growth. And obviously investment in terms of driving the supply of that going forward, also recognised within the white paper. I think the other thing which is really important to note is basically the diversification in terms of how that supply should come. I think the past Cameron government, without question, was very much focused on home ownership. I think there's a growing acceptance that tenures of all type are an important element of the housing supply chain. In terms of conduits, catalysts to actually improve that supply, assisting the funding issues that smaller house builders have, developers have in the sector, obviously recognised. House building fund, clearly there to help drive that. And certainly when I'm talking to institutional investors in the sector, counterparty risk is all important. So may not be the one-stop shop in terms of helping to supply the build-to-rent sector, but just enabling that activity to continue is obviously a really good thing. Institutions, I think, are on the journey. I think those years of trying to persuade them that there is a demand there is an opportunity there, the issues that I used to talk about in terms of quality of management, AST risks when they've been used to investing in 25-year full repairing and insuring leases, that's a big shift. But the student sector has demonstrated that actually developments of scale, well run, well managed, the customers will come. And that's the way that the market is now perceiving this opportunity. So a growing acceptance that actually a short lease can be a good thing. You can capitalise in movements in the market far more readily adapt to what your consumer base is looking for. So I think that's a really, really important thing. I think the one thing that stood out for me within the white paper, we like our terminology in the building industry and construction and property, DMR, discounted market rent, now actually attributed as affordable private rent. I think that's a really interesting sign in terms of the political environment in which we work, and a recognition that affordable private renting is a really key element to delivering these purpose-built build-to-rent schemes. So what's been going on out there? BPF have been doing some fantastic work in terms of improving the amount of qualitative analysis in the sector. I've identified something like 80,000 units in the pipeline across the UK. Obviously, the vast majority of that within London, but we've seen some real hotspots, most notably in Manchester, where about 30% of that makeup comes from. And that's really, again, an economic decision that, frankly, historically, we've always looked at aggregate vacant possession values. Increasingly, investors are looking at an income yield, and that disparity between an income-based asset valuation and the open market vacant possession values basically narrowed to such a non-existent degree. And as far as the rewards for a developer taking that sales risk, they'd gone. So that's basically the fundamentals behind the strength in the Manchester market and some of the other regional cities that we're seeing a huge amount of activity in. So it's happening out there. What can it do? As a sector, obviously providing that good quality rental accommodation. And I think we're seeing the sort of early innovators within the sector really looking at the top tier of the market. I think it's been referred to as a sort of an amenity arms race in terms of the quality of some of these products, taking the lessons that we've seen from the US multifamily market. That's a quick win, but actually the depth of the market really is in that sort of affordable band. And frankly, that sits really well with the institutional sector in terms of their aspirations to match liabilities. So there's a lot of talk about opportunistic property development in the institutional sector. I think that's fundamentally flawed, that argument. They want long-term sustainable income streams. Residential offers that opportunity. There are Other benefits to build to rent. Again, as Mark alluded to, this is some work that the Investment Property Forum did in terms of the ability to drive placemaking, the delivery of the supply into the market. So here's some examples of a pure build to sell scheme of 1,000 units, suggested to take 10 years to actually reach a full completion and occupation. If you go to the far end of that scale, 100% build to rent, you're looking at a 4-year programme. So in terms of trying to meet government aspirations to see more supply into the market, that's a pretty compelling argument. In terms of density, there's some really good designs and lessons coming through from the US multifamily market. I guess the one to draw at the bottom is what we often call in the sector as sort of dumbbell design. So this is very much focused on trying to match a quality product and make it more affordable. So in effect, you've got 2 self-contained studio apartments in one. That's a much more viable delivery mechanism. One thing as a house we've been trying to promote is minimum room standards. We're still struggling, I think it's fair to say, but again, trying to look at ways that we revolutionise what we're actually offering in the private rented sector. This illustration is really just taking what I would consider to be dead space within an apartment, and what that would then equate to as part of the work that we did within some of the sort of recreational resource that's been incorporated within these larger build-to-rent schemes. It's just not taken account of, and I think we're missing a trick. So ultimately, that can then be passed through in a rental, in terms of a lower rental demand, and actually making the wider service that much more deliverable. Ultimately, all of this leads to greater housing supply, which I think is the exam question. So, in terms of active players in the market, obviously I've touched upon the sort of institutional sector, but it's much deeper. But there's certainly some real sort of true blue-blooded UK institutions in the market. Some of the most active ones listed there. Housing associations, registered providers, again, often get overlooked as a major provider of private rented sector homes, and increasingly looking to build their build-to-rent portfolios. L&Q, probably one of the most active places for people, all with significant PRS holdings. One of my biggest frustrations as an agent trying to trade properties, we don't have enough stock. So what we're seeing is propcos actually being established to create much bigger companies with operational assets. This is going to probably take 5 years or so, I think, before these get to significant scale. But I've genuinely been overwhelmed by the quantum of particularly international capital looking for exposure into the UK residential market. And frankly, we're talking billions here in terms of equity commitment. So talking about a scheme of 100 mil here or 50 mil here is not enough for them. They want firm bases from which to deploy further capital and take exposure to the market. And again, taking those analogies from the student sector, we've seen huge consolidation in the market over the last 2 to 3 years, with the likes of American pension funds, Arab funds coming into the sector to build up holdings. Moda Living, for example, funded by Arab capital. We've also alluded to Delancey's relationship with APG, Patrizia, German fund, Real Start American. So it's a real multinational environment in which we're playing, and deep pockets. Moving then on to some specific live examples out there at the moment. Again, a lot of the stock, the early stuff, is basically converting existing residential premises into what we like to call private rented communities. So this is first one on the left is a residential scheme in Stratford, owned by Aberdeen. Another one that we managed for them up in Harrow on the Hill. And then moving to M&G and some of their examples. First portfolio bought from Crest Nicholson, more existing residential stock, but increasingly their movement into things like Carman Street and Port Street in Manchester, much larger purpose-built schemes that are coming to the market and embracing the facilities that we see in the US market. So M&G really been active in the market for the last 3 years, something like 2,000 units now under their control, and really big appetite to grow that fund. Post the Brexit referendum, there was obviously a lot of talk about M&G having money taken out of their funds. There was a further desire to invest within the residential fund in particular, recognising in these times of political and economic uncertainty that residential is probably a really safe haven. So I think the conclusions are we're not building enough, we're not building it quickly enough, and build for rent can contribute significantly. It really is as simple as that. Thank you.